any type of trader, currency, whatever, there are spans where things work and there are spans where you have to step back. Post analysis is not optional. You'll see a lot of traders that have decades and decades and they say, hey, I don't even do post analysis. I don't need to do it. If you're thinking sizing up and just having the biggest balls in the market every single day is going to make you a stage 3 trader, well, it's not going to. It's just as simple as that.
When you're first beginning, you have to start with the bar. You have to learn the technique, learn the proper movements, build the muscle memory. All of that takes time.
You can't mimic success at the end of the day, right? You can take components of it,
you can study
right,
it,
and really build certain frameworks, but you have to get there step by step to that level. So some of the things that we talked about through the first few slides is there's a lot of what all of this is saying is there's randomness in how you approach the market. There's a lack of consistency of what you're doing because you're searching, right? To an extent, I would say the first 1 to 2 to 3 years, that's absolutely fine because you try different things. For me, it was I tried the Forex market, I tried the currency market, the commodities market. I tried the following the news and making sure I could be on top of that. I tried following the Fed and what they say. Does that have any correlation to anything else? So you go through that cycle. I think that a lot of that is important, and you're kind of Xing out, hey, this doesn't work for me. There are very successful people in the world that follow the news only and trade on the news. Maybe that's something that caters to you as well. There's no one right way of doing things, but you have to kind of go through that for you to know what doesn't work for you and what doesn't work for your lives. So what we have on this slide is some of the very common reasons that we see that we've experienced ourselves, and that TraderLion started back in 2017, 2016. And these are some of the factors that we see, or the struggles that we see as we educate people and interact with them on a daily basis, right? We've had hundreds of webinars, hundreds of interviews that Richard's done with successful traders, and they always point to these factors kind of being some of the most common ones as they were stage 1 and 2. So system hopping, that's fine. You're trying a few different things, but the quicker you kind of get a feel for, hey, this works a little bit more. Let me dig into that system a little bit more, and let me build my frameworks around that. The better, right? Then you get into stage 2. That system works sometimes, and you give away all your gains, and then you try to see if you could improve that system for yourself to move to stage 3. Oversizing, I think there's this notion out there that if you don't trade size and you don't have the biggest balls in the market, you will never make it. I don't think that works, to be honest. So sizing is if you're in stage 1 and 2 and you want to act like you figured it out and you're putting on 40-50% positions just to feel like someone else, that's not going to work. The reason people like that are putting those sizes on and have that conviction, they're stage 3. So if you're thinking sizing up and just having the biggest balls in the market every single day is going to make you a stage 3 trader, well, it's not going to. It's just as simple as that. They've built that through a span of time. They've got there by starting with 5 to 8% positions, moving them to 8 to 12% positions, moving 15 to 18% position, because they're seeing that when this setup works, right, over a few years, a few decades, whatever the case might be, there's no reason for them to stay at 5 to 8%. So they have more conviction that 5 to 8% turns into 15 to 18%. That 15 to 18 turns into 30 to 35. So that's a journey that you have to take. If you feel like you're going to follow someone and they're, you can't mimic success at the end of the day, right? You can take components of it,
you can study
right,
it,
and really build certain frameworks, but you have to get there step by step to that level, right? So that's the second thing. I think oversizing is kind of overemphasized. You have to size up to be, I think at a certain point, oversizing, oversizing is not a problem because you've built the proper frameworks for you to still manage risk, right? So sizing is personal. Sizing is a journey from stage 1 to stage 2 to stage 3 that you will continuously refine and try to get to those bigger position sizes.
Yeah.
Overtrading,
Can I jump in
this
with a
happens all
metaphor,
about.
Rye? Can I jump in? Yeah,
Yeah,
just on oversizing. I think actually kind of Jared Tendler kind of introduced this. It was kind of related, a different topic, but I think it applies really well here. If you're stepping into the weight room for the first time, are you gonna load up 245s on each side of the bench press bar? No, you're gonna hurt yourself, right? But people who have been there for 10, 15 years have built up that foundation, the technique, the muscle, all of that. That's a warm up set for them, right? But when you're first beginning, you have to start with the bar. You have to learn the technique, learn the proper movements, build the muscle memory. All of that takes time. And only with that proper foundation are you able to then, over the years, as you continue to build and learn and all that, then you're able to go for your maxes and really size up the weight, just like you'd size up a trade. So that's kind of a helpful framework. You just because trading is a mental thing doesn't mean you can just automatically skip steps, right? You have to earn the right through multiple market cycles, seeing an increasing equity curve, seeing that you're late stage 2 to stage 3, all of that. And that's when you can confidently size up to try to get more juice out of the uptrends, because you built the intuition, you've built the techniques, you've built the frameworks that allow you to safely do that while managing risk. So yeah, I thought I'd just add that.
Yeah, no, that I think that's super important. You build a level of instinct, like you just know when it's the right time. And that again goes back to that first diagram, right? You have knowledge, you're building experience as you bridge those dots. It just happens naturally. If you try to impose it upon yourself because you feel trader XYZ is doing this, or if you try to follow someone, they say, oh, I have a 45% position in this, and you feel the need to be doing the same. They know what they're doing. You might not know what you're doing at the end of the day, right? So um, the fourth one here is randomness. So what is randomness? You feel like you try different things. One day you might buy a position based on, let's say, relative volume running high, right? The next day you completely throw that out because that particular day relative volume being high through a pivot didn't work, and now you feel like that's a load of BS. Now I need to go try something else. And then next day you buy a position based on RSI. And all of these examples is what I did. So when I'm kind of talking to my past, is I've done this. So setups, I've tried setups where the MACD would cross over, and now I'm trading MACD, and all of a sudden, 1 week it doesn't work, and I scrap all of that, and then I go to some other technique. What that introduces is a lack of consistency and seeing through what may work. So one thing in the markets is all the indicators that we see on any platform in the markets are based on some sort of people coming up with it, right? And what happened was the reason they came up with those indicators is because those indicators worked for them, right? And that's why I say all indicators work. They all work. It's just the lack of seeing through, if you stick to, I can build a whole system on RSI, just simple price, volume, and RSI. People trade that way, right? The RSI 1 or the RSI 3, Larry Williams type of thing, or the RSI 14, one of my earlier mentors would look at RSI 14 going above the 70 line as a powerful signal on the weekly and monthly, right? All of these indicators work, but it's a lack of, people just, there's this level of, if this doesn't work in week 3 of 52, I'm going to go switch something else. Try week 4, it's something else. Week 5 is something else. Week 6. And you just confuse yourself. You're in a state of like daze. You're just dazed because you're just trying to figure out how quickly can I figure something out, so that how can I make all this money very, very quickly and be very, very rich. None of that happens. It won't. It just won't. And that causes randomness. And basically you're not seeing through, right? People trade on Fibonacci's. And I see people, social media, friends that have personal opinions, Fibonacci's don't work. They work. Everything works. People just invest a lot more time in looking into Fibonacci's and finding a consistent pattern, right? That works for them. And now they have mastered that aspect. So that's one thing, randomness. Let's move on to next is maybe Richard, you want to add something to the randomness part?
No, I think you covered it. You also didn't dive too deep into overtrading if you want to come back to that one.
Yeah, overtrading, I think, what we will cover and spend a lot of time here, over the next 7 weeks is how do you build, how do you stop yourself from yourself, right? There are times in the market, let's say I am a short trader. I want to master short trading on the short side, no matter what, right? That's my goal. And that's all that I want to do. Is it doable? Yes, it's doable. But there are certain times in the market that I need to wait for so that I can have the biggest impact on my equity curve. And I need to build my trading around that, right? If you want to be a long trader or a short trader or any type of trader, currency, whatever, there are spans where things work and there are spans where you have to step back and just, put your hands up and say, I'm going to wait for that exact, moment or that span that where things I know will work for me and my system. And that's how we could avoid overtrading. What happens is people want to come into the market, I don't like this political party. I feel like the S&P should go down, right? That's how you get clobbered and absolutely give back a lot of money. So, and they want to trade. I want a system that works 52 weeks out of the 52 weeks, works from 9:30 to 4 p.m., no matter what kind of market it is. That's how you would go into this mess of overtrading. There's no such thing as a system that will work for 52 out of 52 weeks, right? And you place a trade every single day. You go 252 days, trading days, and you multiply, you're placing 600-700 trades. So number of trades, right? Look at the number of trades you're placing. Does that align with your lifestyle? Does that align with your goals? Does that, at the end of the day, align with your system, right? Are these system-driven trades? Are these frameworks that you put in place, are they driving your decisions? And that's how you could avoid overtrading. I think just looking at the number of trades, for all of you that are here and watching the recording, just look at the number of trades you're placing. It's just, it's a very simple metric and you could go back and trace back from there, right? Richard, feel free to stop me or, chime in on any of these.
No, I think let's keep rocking and rolling.
Yeah.
Yeah.
I think, I'll be a lot quicker with the rest of them. So overconfidence, underconfidence, we go through these emotional highs and lows when things are working. We feel like there's nobody that can stop us, and we doubled an account from 50 to 100,000, and there's no room for improvement. We felt that, people feel that. And then there's underconfidence when we hit a bear market. One of the more aggressive bear markets that we've had in recent times, which was 2022, and you kind of lose that confidence because you lose that belief, you lose that, you feel like all the knowledge that you've gathered is for no good because you're trying to apply that knowledge in a market phase or a market cycle that it's not particularly useful in, and you kind of lose all of that confidence. And all of that is related to there's times things work, there are times things don't work. And there's just cycles, right? As long as you're in tune with that market cycle, you know that the systems you put in place work for certain spans of time. We can avoid underconfidence and overconfidence cycles. The next few, we've gone through this, too many indicators, buying late and extended. All of these are a lack of just not having buy and sell rules. And I think the last one that's most important is no post analysis. So people tend to let's say, I'm in the markets and I'm building experience, right? I place a trade. The market tells me, hey, this is a loss. right? So, and then you just flush that and you say, okay, I'll try again, and I'll go and place a trade, and then that's another loss, or I go place a trade and I make a whole bunch of money. If you go back and just look at what is happening, it will give you a lot of personal insight as to what you're doing, why you're doing it. And there's this, stage one and stage two post analysis is not optional. You'll see a lot of traders that have decades and decades, and they say, hey, I don't even do post analysis. I don't need to do it. Why do they say that? The reason that they say it is because they've been 3 decades into this. They've been, 35 years, 20 years, 15 years. They get to a point where they know psychologically and mechanically what they're doing that's not working. Do they need to take time off? And you build that over a span of, 15, 20, 25 years. And there are traders that have been in the market for 30 plus years, and they still do post analysis, right? But what I think, stage one and stage two, if you're not looking at what you're doing, you're making it harder for yourself to move to stage three. And it's really as simple, as that you have to look at what you're doing. You have to analyze your actions. It all allows you to improve your systems, your risk management system, your trade identification system will all improve if you just go back and just look at what you're doing, right? Look at what you did in 2022. People just don't seem to do that, and they feel like they could just figure it out and just they're forward looking, right? There's no rear view mirror on what's happening. They're continuously losing money in the markets, and they refuse to look at why they're losing money in the markets. So stage one and stage two, it's not optional. Stage three, I know traders that still do it to this day. I know traders that don't even, they know what's wrong with them. They need to take 2-3 weeks off and come back. They're in a down, they're in a rut basically, or they're mentally and physically just exhausted and their decision making is not good. And they don't do posting. So there's both spectrums of that. The last one is FOMO. I think regardless of the level of experience that you have, you'll experience FOMO. So people, that's, I think, if you put a timeline and you put all these issues on a timeline, FOMO should be across the board. It's infinite. It's always going to be there. That's in some way, shape, or form. It's not about eliminating FOMO. It's about minimizing, reducing, doing things. Can I do this a little bit more mechanically so that I don't make an emotional decision? These kind of these things are what reduce FOMO. You still always will feel it to an extent. All you're doing is, as you build experience, you're kind of tapering it off. Slowly you're bringing that level of FOMO down. You're reducing it. You're not eliminating it. So if you think you can eliminate it, let me know. You might have a pill that I don't have at the moment, and I would love to buy that off of you. But I think that's, FOMO will always be present. You just need to figure out ways to minimize it.
Yeah, and in the chat right now, let us know, what do you think of this list, especially if you're stage one or two? What do you think are the two biggest issues that you're dealing with? Maybe then we can develop a resource to kind of help with those specifically. But yeah, really curious to hear that. Emphasizing buying extended late. This was actually back in 2019, the biggest thing I noticed, biggest mistake I was making over and over again. I was identifying the right stocks. They were strong, all of that. They had all the can slim characteristics, but then I would buy it, after it already moved for a few days. And then you get confused why you get stopped out all the time. It's because you're not buying at a compression, a spot where, I can logically manage risk. So going back and doing that post analysis helped me immensely, because just eliminating that increased my win rate and increased my, reward to risk ratio, all of that. But if you don't go back and look, you can't magically realize what your problem is. You have to actually chart out your mistakes, and you'll notice the trends, because you are a human that makes, you're pattern based, right? You're trying to buy at the same spots. But if you're buying at the wrong time, you won't notice that unless you actually bring up the charts, bring up your losses, chart your losses and your wins, all of that. Also, when it comes to 2-minute indicators, when I was first starting out, I had MACD, I had RSI, I had stochastics, I had all that. I created my own, secret indicators that were magic buy points and sell points. Everything is completely simplified now. And I know Mark and Les in the chat, they've been trading for decades. I'm sure if you take a look at their charts, it's going to be very simple. There's going to be a few indicators maybe that they have mastered. They've learned those tools and mastered them. But, by and large, keep it simple. Focus on price, volume, and maybe relative strength. David Ryan, price, volume, relative strength. Oliver Kell, price, volume, a few moving averages. There's, again, the best traders on
Dan
earth.
Weinstein.
Stan Weinstein.
Horizontal lines and stage analysis, as simple as it gets.
Yeah.
Right.
Keep it simple. And really learn to read price action